All right. Well, welcome everyone. My name is Glenn Thompson. As you see on the screen, I have been working as a mentor with Pacific Trading Academy since the beginning, about 14, 15 years now. It's been a while. I've forgotten. Initially, I want to thank Adrian and her organization, Trading on Target, for inviting me to uh, share my insights concerning timing relationships. Today's presentation is called How Market Timing Can Supercharge Your Trading Edge. So I want to discuss that. If you have questions beyond what I'm able to address in the course of today's presentation, we are recording it, and you can obtain a copy of that. I'm not sure if we send them out de facto or if you have to request it, but in any case, they are going to be available. You can reach me as well as Pacific Trading with the contact information 800-339-8588 or the website www.pacifictradingacademy.com. Again, I may be talking to an audience that I don't normally talk to, so again, Adrian, I appreciate your invitation. So let's begin. If there are questions that arise during the course of the presentation, and I can address them in a cursory manner at minimum so as not to disrupt the flow of the slideshow, great. If not, there should be plenty of time at the conclusion at the end of the slides. So let's begin. Wrong button. Let's see. How did that happen? Bear with me, folks. Not sure what just happened here. Okay. Hit the wrong button. Just to repeat, let's start just giving you some background. Timing should always take precedence over price. I mentioned I've been teaching and coaching for 14, 15 years with Pacific Trading. I've been trading for more than 30 years. And in the bigger sense, in the bigger context of the analysis involved for trading, we're dealing in probabilities. Most traders, I realize, don't take into account market timing. It is an area of particular interest to me, and I look to timing for the purpose of improving my edge, so I can garner a greater degree of edge or of likelihood concerning a value area that my analysis in total hopefully has captured or led me to or derived. So I take an extreme view. I realize most traders don't focus on market timing. I do ascribe to the underlying technical premise that price discounts everything, and I buy into that. If to the extent I want to acquire a greater understanding as to why a market is doing what it's doing, why you're seeing certain types of price returns, I happen to believe that certain specific amounts of elapsed time have strong connections or correlation to the way by which price discounts all information. So as such, timing should always take precedence over price if we're thinking of the price returns of the behavioral features and components of a market's behavior. From a cause and effect standpoint. In other words, to the extent we want to acquire some greater understanding as to why a market's doing what it's doing, I think specific time period analysis will go a long way towards accomplishing and giving us great insight on that. This is not an idea of mine or an original idea of mine. It certainly is an idea that I apply and look to and utilize, but many people. Gann was, I guess, the key person that I would attach to this concept. He was certainly not the only one, but in the early 1900s, he had brought about and focused on this aspect of the incorporation of time to price. More truthfully stated, Gann's deeper insight was pointing to the equivalency of price and time. They are mere in a figurative sense, the two opposing sides of the financial market coin, as it were. Gann's insight is vibration is to the key to the markets. So you cannot have vibration, or you can have vibration is a phenomena that occurs on a time, price, or a time-space platform, if you will, or a foundation if we're thinking in 2 dimensions, on a 2-dimensional platform. Vibration creates repetition, creates infinity, and I always like to illustrate this as best I can in a slide 2-dimensional array by which I'm presenting to the members of a listening audience in a webinar. For example, the sentence on the next slide is true. So we interpret what we're looking at right now, and we ascribe or impute some meaning to it. The sentence on the next slide is true, and that means what it means to you. So let's move to the next slide and see what it says. The sentence on the previous slide is false. So right away, it causes a vibratory, we go back. The sentence on the next slide is true. The sentence on the previous slide is false. Back and forth, back and forth, back and forth, creating motion out of a static entity. We create a flux of momentum. And so this is just I thought that would be nice to illustrate those. I've done that before, I think about a year ago in a previous presentation on market timing. But this is all phenomena in our universe, as far as I know, is based on vibration. Financial markets, be it a stock, a commodity, a currency, a precious metal, any freely traded market ultimately can be looked at from a very deep standpoint if we're looking at it as a system which is engaged in vibration, and vibration is arising out of a self-referential series or model, and this illustrates it, that series of 2 slides. The moment we attach truth to one idea, in order to maintain a consistency of self-reference or a self-referential consistency, there's a paradox that arises, and it also creates sets off a motion. Energy, the need for survival versus my cup runneth over, and I'm giving you now, guys, a theoretical foundation or basis for why time is, where and how time comes into price action, price behavior, market behavior, let me say. The need for survival versus my cup runneth over. So if we start theoretically with this precept that all objects absorb and reflect energy. So, and then I'm going to make the jump that a financial market, be it a soybean or a jelly bean or anything in between. I was in a meeting years ago and Larry Williams made that joke. But in any case, all objects absorb and reflect energy. Every object has its particular frequency at which it best takes in energy, as well as those frequencies that are reflected. Let me stop there and just elaborate. Everything in the world or universe external to you and I as a human entity in this world, the way by which we discover or acquire knowledge and insight and learn something about anything is a result of a reflection. We throw something up against the system or the thing that we are interested in, and based on inference about the interaction that occurs is how we acquire new knowledge or information. We know that an apple is red if we look across the room and on the table we see this object we know or define or label as an apple, because it has absorbed the photons from the light source wherever they may be. It might be a light in the ceiling, it might be the sun shining through a window. Whatever frequencies of vibration are absorbed, we do not see. It is the frequencies of vibration that are reflected off of the structure of the skin of the apple, let's say, that we define, we've come up with this word called red or green, whatever the color of the apple might be. There's a certain frequency or wavelength of vibration, and we have established or defined it to be, say, red, for example. And it is that which is reflected, which then somehow meets our visual apparatus, let's say our retina, and we define it as of a certain wavelength or frequency. When I use the word wavelength and frequency, they are inversely related. They are one and the same. They're just 2 different ways of looking at the same underlying physical phenomena. So that I just merely pose as an easy example to illustrate the process. So let me jump back to the market. When you overlay a moving average, for example, on a price chart, a two-dimensional system, you are essentially throwing something up against that system, the market, be it a stock, it could be Apple Computer, it could be the S&P, it could be soybeans, it doesn't matter. You're essentially throwing an object, albeit in a more sophisticated manner. You are applying something, and based on the interaction of a tool, we call it, say, a moving average, and its response and reaction, the sensitivity of the market to that particular item, a tool, based on whatever happens is how we hopefully at best are able to acquire new information that to some extent might give us or more edge in our side of the ledger. Okay, every object has its particular frequency at which it best takes in energy, as well as those frequencies that are reflected. What determines what frequencies or wavelengths are absorbed versus those which are reflected have to do with the structure of the object. The internal structure, its molecular and or atomic or however low down you want to go, its structure determines what frequencies are absorbed versus those which are reflected. It is that which is reflected off of something, be it a static object or a dynamic system such as a financial market. It is only those things that are bounced off of or reflected from something that enables us to acquire new insight and knowledge concerning that something. So in this respect, financial markets are the same thing as any other object. At frequencies specific to different markets, a market will resonate with certain energy impacting it. This is an important point. At frequencies specific to different markets, a market will resonate with certain energy impacting it. And the point here is that different markets have, for whatever reason, based on their internal configuration, are more sensitive to certain frequencies. One market might be sensitive to a given frequency, another market might have a different sensitivity, more receptive, more susceptible to accepting a certain frequency. Those which are accepted imbue that system, that object, that thing with energy. Those which are reflected, it gets none of it, and that's turned out to the universe external to it. Should a market, and so think of it this way, the higher the frequency, just as a general principle of natural law, the higher the frequency, the greater the energy. Things that are of greater vibratory rate have higher frequency. They contain or carry greater degrees of energy. Things that are vibrating less frequently, lower frequency, longer wavelengths, don't carry as much energy. Should a market receive too much energy, its structure will explode. This is the phenomena that ends trends. If I may age myself here, guys. If you remember, years ago there was a commercial that used to run on television. It was I think an audio cassette. Is it Memorex or is it live is the thing, and they had an opera singer in a room with a very fragile kind of champagne or wine glass and hitting a high note. And what is sound? It's merely a vibration. It's a vibratory phenomena of the atmosphere. So if you increase the vibration and the frequency, at some point you're increasing the energy. If there is a frequency, let's say that the structure of the glass, very thin or fragile glass, whatever its structure is, there may be a certain frequency that it is sympathetic to, it is acceptable to accept. And again, whatever frequency is absorbed by a thing or a system, it allows energy to come in. To the extent there is an amount of energy that reaches a certain threshold beyond which there's no further room in the container. In other words, it's almost kind of analogous to if you have a pitcher of fluid, of water or whatever, and you put it into a finite container. At some point, if you keep pouring in the liquid, there will be no more room. Where does it go? Well, if you're not increasing the size or the volume of the container, it will force it to explode. It's got to go somewhere. And this is the phenomena that as technicians of price charts, we call turning points, bottoms and tops, pivot points. You call it, these are just labels. A word is just a word. The underlying phenomenon is basically the same. Should a market receive too much energy, its structure will explode. This is the phenomena that ends trends, and that's the theoretical. This is just a theoretical reason as to why I believe time is critical and often can give me some edge. I'm not suggesting from a practical standpoint we place trades and make trading decisions solely on time consideration. So I am saying it can, to the extent, okay, thank you, Ed, for giving me the Maxwell Maxwell tape and Memorex. Okay, I guess appreciate that. All right, so that was just setting us up, guys, for a theoretical. It's one set of linkages of ideas that would explain. It's a theoretical construct as to why trends begin and trends end. A trend, essentially, let me make it a quick synopsis of this. When a market, which is if we're thinking of it as a system, you can call it, put a title on it. It could be Apple Computer, it could be Tesla, it could be soybeans if you're a commodities trader, it could be Euro USD if you're a Forex trader. Doesn't matter if you're a long-term position trader, long-term investor, or a hyper-frequency day trader, or any time window in between. Markets are fractal, they scale, and they respond to energy. I always jokingly tell people a market doesn't know anything explicit about the world outside of it. It doesn't know that the Federal Reserve is what they did in terms of interest rates. It doesn't know about the political ongoings of the current administration or any other. It doesn't know about geopolitical events. By the way, as a side note to that, having not much to do with my topic today, to the extent a market could perceive anything explicit about the world external to it, it could care less. Markets just move, is my belief. They just fluctuate forward and evolve forward through time. But the way a market perceives anything about the world external to it is through the sum set of orders, the collective of all the orders that you and me and all the tens of millions of traders worldwide do. We hear a piece of information, i.e. news, let's say an event, fundamental, okay, and we assess and infer and reach certain decisions concerning its potential impact on that market, and combine that with our motivation to make money, to profit, to generate a financial ROI, and we place orders. Multiply that phenomena times hundreds of thousands or tens of thousands, if not millions of times, and indirectly markets interpret, and that's how that collective of orders, and how the orders in turn must be broken down, and it's the consequential byproduct of that information breakdown that is represented by a carom of money or monetary return. If you're fortunate, of credits to your account. If you're unfortunate on one particular campaign, a representative of a debit in your account. In any case, should a market receive too much energy, its structure will explode, and this is what stops a trend, either at a market top or a market bottom. The destruction of one regime allows for the onset of an altogether different regime. We refer to it, again, from a technical vantage or perspective, as a market top or a market bottom. This is just an underlying energetic explanation for the phenomenon. And there are a myriad of ways by which we might define it. This is a deeper way, I believe. Okay, so energy generation in a wheel. It turns out a lot of in a lot of the analysis that I do to to affect market timing. And again, let me just make this cogent for you guys. I don't mean we could go on. I've been doing this for 30-some years, studying market timing, so I want to be very succinct and to the point. There are many, many ways. The whole point, the utility, the purpose of market timing is to enable you and me, the operator, the observer, the practitioner, the trader, the investor, to have or to project in advance when it is a market's going to change. In its broadest, most general sense, that's what it does for you. When it works, and it's not perfect, nothing is to that I am aware of. I don't know of any one particular model, method, system, you name it, indicator, relationship that is perfect. If I did, I jokingly tell people that I consult and work with and think about all the time, if to the extent you come up with a perfect idea, keep it to yourself. If at the end of your existence you decide to bequeath it to mankind, great, for whatever reasons, humanitarian, beneficent purposes, or just ego, whatever, or all of the above. But capture the majority of the wealth of the universe. But to the extent, as a consequence of the systems we are interfacing with, i.e. financial markets, whatever they might be, you find something that is the perfect equation or set of equations that defines market behavior perfectly. Don't release it, because to the extent it is perfect is the extent to which its performance will begin to trail off once it is known and becomes pervasive in the market. It's just a consequence of the feedback loop that exists between price action and our role. We are the market in an extent, depending on how your purchasing power and your buying power and the level of equity and so factor. But in theory, we are the market. Okay, I say that as a precursor to indicate there are all sorts, barring perfect knowledge, perfect equation, perfect understanding as to the dynamics and features. It's not a Newtonian world. They're mixtures of linear motion and nonlinear motion, but barring a perfect understanding of markets is why we need money management, is why we need trading psychology, because we have to know how to deal with losses, the emotional detritus that can linger and typically, or more often than not, adversely impact our decision making going forward. We could have a perfect system. If we are not, as human beings, wielding it appropriately, it can adversely impact we can take away and mollify and degrade the performance of a system. But suffice it to say, there are certain geometric shapes, I'm going to jump here to the market timing, that I utilize for some of the ways by which I'm able to project when it is a market's going to turn out in the future. Again, that's the starting point. At its best, market timing will tell you in advance often when a market's going to, and I'm simplifying here, form a top or a bottom. That's not quite 100% true. Sometimes it will work out that, but more generally, a change. One type of change is clearly an outright 180-degree reversal where a market would stop trending higher and reverse and come down, or vice versa, but that's not the only type of change. Essentially, in the broadest sense, market timing enables a trader with varying amounts of reliability to project when in the future a market will change. Well, at minimum, let's say you have that, you're armed with that. At minimum, that would provide an impetus to look more intensively at and locate and see if other say price-related phenomena, factors that are related to the vertical axis of price motion, are similarly auguring for a certain type of changed motion. You see, if nothing else, it's on the continuum of probabilities of advantage you can acquire, because the whole process of speculation, be it whatever your arena is based on probabilities. So one of the theoretical constructs and foundations that I depend on to help me project when a market's going to reverse are certain geometric shapes. The most in the circle, the triangle, the square. They are the most important structures geometrically, let's say, that help in all types of analysis. By the way, not just market timing, but also price. Again, a key insight of people like W. DeGan in the early 1900s, Wyckoff, J.P. Morgan. A lot of people, we are all familiar with J.P. Morgan, a great banker. A lot of people did not know he was also a very astute trader. J.P. Morgan, as a side note, said, if you want to make millions, do not use market timing. If you want to be a billionaire, you must use market timing. Now, you may or may not, it may not be a personal goal to be a billionaire. I'm just highlighting that as a dropping a name, but as to indicate the degree of importance I place on timing. Okay. It turns out that a circle is the most important geometric shape insofar as a lot of the analysis I do for both price and time. The circle as a shape has important ramifications much greater than just mere market analysis, but again, for today's presentation, I'm focused on a narrow niche, and that's just the analysis I do in market timing. The reason a circle is so critical and integral is it has infinite symmetry. Without getting too far, it suffices to say everything in our universe is based on a circle in a lot of different ways. It turns out, again, from a theoretical standpoint, when we divide a circle, the 360 degrees that we typically divide this or think of the circumference of a circle as constituting that circumference, certain fractional parts of a circle play very important roles theoretically in how our universe is set up and in turn a part of our universe, i.e. financial markets. It's not all that big a stretch if we realize that financial market behavior is a reflection to a large extent of a lot of the things that happen in our day-to-day life as humans. When we understand certain mathematical constructs such as a structure as a circle, we can often exploit this to our advantage. Again, specifically, there are certain particular what I call harmonics of a circle. That's just a fancy word to indicate certain important fractional parts of a circle. They go by these different names. It doesn't matter if you're familiar. If you are familiar with the names, great. If you aren't, don't worry about it. That's just a vestige of learning the system. But what's important is that certain harmonics of a certain, or other words, fractional parts, when there's zero fractional part, if you were to divide it, it's called a conjunction, meaning a coming together, I think from the Latin or the Greek or whatever, I don't remember. An opposition is simply 180 degrees of separation between 2 points on the circumference of a circle. A trine, 120 degrees. Think about tri for, the prefix for 3. If you were to divide the 360 degrees of a circle by 3, you get 120 degrees. A square, 90 degrees, a perpendicular, a right angle. We all are familiar with that. And a sextile, 6 into 360 is 60 degrees. Now, there are others, but these are the most important. There are some almost as important, but these are the 5 most important degrees or fractional portions of a circle. For many reasons, and in particular for practical purposes of enabling me to project when in the future, often very precisely, often, if I'm a day trader to the minute, if I'm a position trader, often to the day, depending, not always, but sometimes, depending on the particular technique and the application. But these are some of the things that I do, as you'll see in a second. And this is why this is so. Energy created by certain angular configurations is self-sustaining. It will reinforce itself over and over as it moves around the circle. Now, let's remember the previous slide, I think 2 or 3 slides ago, where I said the more energy a system takes in, the more life it has, the more capacity it has to survive up to a point. Remember, you fill the wine, if that fragile wine glass or champagne glass takes in too much energy, it overrides its boundaries. It has no place to go. It has to go somewhere. So what's left? If there's no space, it must break out of its container. And in the breaking, it destructs the system. That falls apart. The glass shatters. Similarly, you fill a container that's finite volume in size and shape, and if you continue to pump a liquid or a substance in, it has to go somewhere. If you run out of space, where is it going to go? Well, it will do everything it must as a function of the tug-of-war of pressures to break out, and in the process of breaking out, the container is destroyed. And it is that phenomena that stops a trend. We call it a top or a bottom, a turning point, if we choose, if we want to be a little more specific to get the connection. Okay, it will reinforce itself over and over as it moves around the circle. Energy created by certain angular configurations. Which ones would they be? The ones as indicated by these degrees of separation with reference to a 360-degree circle. 180 degrees of separation, 0 degrees is very important, and 180. They are two subspecial, for certain reasons, the 0, which is called a conjunction, and the 180 oppose one to another. They happen to have very catalytic properties. The others are all important, but those two in particular have the similar properties, but even added so. but that's a detail. But these all tend to have a property. Why do they have this property? Because of this. Let's say we're a little homonucleus, as they call it, sitting at 0.0 degrees, just point B on the diagram, and I were to throw a baseball or a projectile 90 degrees to point to my receiver. It turns out, knowing another principle of the universe, an angle of incline or income equals an angle of outgo. It's just a function of our universe. It's a natural law. The angle of incidence equals the angle of leaving. And so this has the effect of creating, if that's 90 degrees, that this is just illustrating, and it reinforces, and the energy tends to magnify, and it's what we call a constructive wave. It's just wave dynamics. Versus if a different, I don't know why it is, there's something particular about that particular fractional part or harmonic of a circle, and that's known as a square. When you subdivide the 360 by 4, it's the fourth harmonic of a circle, and you have that property, the energy reinforced, and it self-sustains. And as such, that allows for energy to continue to come into the system. If you allow for energy to come in, continue, and don't turn it off, at some point it will fill it to its capacity and then beyond some, and that energy has to go somewhere, and that is what creates the cessation of a given trend. Versus a altogether different frequency may not be self-sustaining, a destructive, non-standing wave. If I'm only 80 degrees, it doesn't have that property. And so from a theoretical harmonic standpoint, that's an explanation as to why certain frequencies, certain harmonics are important versus those that are not so important. All right. This is another, this has to do with what I alluded to a second ago, the conjunction. When there's 0 degrees of separation in a circle, it's a very powerful trigger. It's kind of like snapping your thumb, the angle of approach and the angle of exit. But imagine just here, this is what we call just a conjunction resonator. Imagine these two vectors, these lines, as just containing a region of positive charge and within these two lines, and on the outside a region of negative charge. Imagine at the center of these two lines is a pin, and keep one of these lines stationary, and one of them is rotating around just as a circle, like a clock, I guess. If there's a free charge, at some point, I must include this one other principle. Just recollect your high school or junior high, whatever, physics. Like charges repel each other. So a region of positive charge, they tend to repel each other. Regions of negative charges repel each other. Positive and negative charges attract each other. Like charges repel. We've got to know that to understand this concept. So if we were to rotate one of these lines, line 1 or 2, it doesn't matter, and keep the other one stationary, at some point the amount of space, it's kind of like we're decreasing the volume, the space allowable to contain this charge, to illustrate the phenomena I want to show here as to why timing is so critical. To the extent we were to, let's say, rotate this at any given speed, it can be fast, it can be slow, it doesn't matter, the fact that like charges repel, there's going to set up a frequency of vibration as line number 1 gets closer and closer to line number 2. The space within which this vibration occurs is going to get smaller and smaller, increasing the rate of vibration. At some point, literally, when they are conjunct, they have come together in the limit where they are one line 1, let's say, is overlapped or superimposed perfectly on line 2. There is 0 space. What happens? It's almost like, imagine yourself in a room, and where the ceiling, the floor, and the 4 sides. If you're on equally at an equal velocity, bringing all the sides of the room together, you're diminishing the space at equal rates from all sides. Where at some point you're going to run out of space. And if you're present, where are you going to go? Well, it's almost, I remember a professor saying years ago, when you can't figure out something and you've considered all the things that you think to be possible and you still can't reach any new insights, consider the impossible. By definition, if there's 0 space for this region for the positive charges, when line 1 is on top of line 2, and they are completely perfectly conjunct. In the limit, as we say, the region of positive charge in an infinite theoretical charge goes to the other side. It must squirt somewhere. Similar or analogous to when you fill up the wine glass with so much energy and there's no room left in the structure to contain it. Where must it go? It must somehow, some way burst out. And in the process of escape, it destroys the system. When that happens, I don't have a dynamic screen. I wish I could do this, but it just, the top here would be prior to the rotation, and then you can see line number 1 is below, and then if we're holding line number 2 stationary, line number 1, they shift positions. And then there's been a polarity shift, and in the process there's an infinite current that is created because it has to go somewhere. All right. This is just another aspect of this as to why the circle is so important combined with this phenomenon. Imagine if you're sitting here at the due east position or the 3 o'clock position on this circle, and you have this energy, if the region of charges, and I've got the vectors, imagine this coming to a point where it would be conjunct the other line segment. Well, at some point the energy would squirt across, similar to what the previous slide indicated, and it would make its way out to the circumference, and the wavelength of the vibration is equal. This is just a more specific detail as to how a conjunction resonator works, is equal to, or the radius. And it turns out that after it has moved 3 radii, in either direction. I just indicated an arrow to indicate the north going upward, but it's similarly going the same way. When it's traveled 3 radii around the circumference, it happens to be an important harmonic. Again, 15 degrees. This is why I don't want to, and the difference between, 1/2 the circumference of a circle is 3.14 r. Remember pi, 3.14, the radius, that's 1/2 the circumference. Well, it turns out that if the energy, that if it were to squirt across as a result of like coming together of those 2 lines so that there's nowhere to go, if that energy which squirts out or comes out to the circumference, it goes in both directions at the same time at a wavelength equal to the radius. And it turns out once it's traveled 3 radius, it is at approximately 15 degrees from the 0 point. And so if you do a little arithmetic and manipulation and determine what the difference is between that and 1/2 of the circle, it's 44%. And if you take 44% of the 360 degrees, it works out to 16 degrees. But the closest even divisor of 360 is 15 degrees. It's actually 15.8, but it's not quite 15, but the closest even is 15. And that's why 24th harmonic, that's why we have 24 hours in a day. That's why there are 24 time zones, each one equal to 15 degrees around our globe. That's why the 24th harmonic is so critical in our universe in so many ways. And harmonics are just important multiples of something, and also certain important fractional parts. So the 1/2 harmonic of 24 is 12. 6, the hexagon, that's why so many things in nature are 6. And 3, the Star of David, which is the internal components of certain fruit. 6, the logarithmic spiral is often a function of the hexagon. Why is that so? Well, it has to do with certain fractional parts of a circle, and it's an energy consideration. So all of these things, it's not important that if you get what I'm saying here, great, but if you don't worry. This is just the underlying theory of how and why I have confidence in my market timing to the extent I do. All right. Now, this is a practical step. How do you move from theory to practical application? Connected to my iPad and not okay. If someone's saying that you're not getting a good connection through your iPad, just so in case you didn't hear, we are recording. So hopefully, if it's not crystal clear, hopefully it will be clarified in the recording that you are privy to once we complete. So I apologize for the person who's not getting the best audio, but hopefully the recording that you're going to be able to get will clarify any points you might be missing audio-wise. All right. Now, everything I've said so far has to do with providing a little foundation theoretically. Let's take this to the real world. Again, folks, I just want to emphasize it's not my intent in the course of an hour presentation to go through what I've covered and learned over 30 years. And most of the things, just as a side note to that, although I have come up with some interesting and hopefully profitable ideas of my own over the years, most of what I've learned has been on the, you know, as a consequence of research, like from people such as Gann and many others like him. You know, he was not the only one. Robert Krauss more recently, people who have done a lot of cyclical analysis and market timing, harmonic analysis, Fourier analysis, how to determine cyclical periods and so forth. So I'm just trying to give you the tip of the iceberg so as to whet your appetite concerning what I refer to facetiously as the neglected dimension of market behavior, which is the horizontal dimension or time. As Gann said, a market will do what it's going to do once its time has come. Okay. One of the techniques to determine a cycle endpoint, very simple, very straightforward, I believe, at least in principle. Yes, there's some details and there are many variations on a theme, but overall it's not anything too opaque and too complicated. Locate a high or a low day, or if you're, oh, by the way, most of the tech, there are some specific things where they don't apply, or they apply specifically in one domain or window of time and time horizon and don't apply to alternate. Most of the techniques I apply and use in my own trading have universal application across different time windows. What I apply on a daily chart or weekly or monthly would be equally applicable on a 4-hour chart, 30-minute, 20-minute, 15, 10, 60-second tick chart, etc. There are some exceptions to that, but 80% or so of the technique that I utilize will apply sometimes with some adjustments to take into account and in deference to certain factors that are peculiar to a certain domain, but more or less they are not core theoretical changes. They are just some adjustments that are necessary to exploit and maximize and get an optimal application. All right, steps to determine cycle endpoints. Locate a high or a low day. How do you do that? Well, just look at a price chart. There are other ways that more sophisticated traders watch and monitor price action. The standard way, however, most of us look at a simple two-dimensional flat surface, a plot of price as a function of time. There are other ways to do it. I know you can look at phase space diagrams and all sorts of very rocket science, esoteric methodology. But barring that for the moment, we just primarily, if you look at a function of how price evolves given time elapse, a time or a price time plot. Locate an obvious extreme point, a high or a low. I've indicated a high or a low day. If you're a day trader, it would be a high or low point, a top or a bottom as observed on in your intraday chart. Again, most of the market properties are fractal, meaning there is a self-similarity of structure much of the time. Not perfect. It's not a pure mathematical in the real world. We know that the real world is often sloppy and messy. But theoretically, we see structure that attracts and creates a certain type of motion that is attracting or gravitating to an underlying attractor, if you will. All right. Having done that, on one of the techniques I do, it's very specific and very objective, and it makes it clarified and able to be repeated, and you can trust in it. On the high or low day, observe the aspects that the fast planets form with the slow. Now let me stop right there. I've just made a jump. All of a sudden I'm talking planets. Previous slides up to this point, I was showing circles and talking about the harmonics, which are simply fractional parts of a circle, the 360. Let me explain the jump. So for those of you who are familiar and know where I'm going, great. Bear with me for a second, just in case. I don't want to lose anybody who might be disenchanted with this. First of all, I've in the past given presentations on timing, and when I get into celestial relationships, some people, for whatever, think, oh, there you go, market astrology or something, there may be a negative connotation to that. If there is, I have none whatsoever. If those of you within the sound of my voice now have no such hesitation or trepidation, don't worry. If you do, here's my answer. Just think of this as numbers or numerical correlation. Trading as an endeavor in the broadest sense, again, let me go back, is all about probabilities. I utilize X, Y, and Z technique or indicator. I look at an RSI, I do a Fibonacci, I do my Elliott, I do whatever you do, all for the purpose of what? Hopefully, when the sum of all the tools work, giving me some probabilistic gain or advantage over the trader on my left versus the trader on my right, so that when I apply it and put on a position that's hopefully exploiting what the sum of my tools has shown me could be a mispricing in a system I'm studying, if I'm correct, to some extent, I can extract as a consequence of the reaction between the market and the position I've established, how that alignment pans out and evolves forward through time, some financial return. That's the whole process of trading and the purpose of it in the nutshell. Okay. So when I make this jump, just because it's what I do, or one of the things I do, think of our solar system as the circle. When I speak in terms of planets, think in terms, let's just this conjunction razor. Think of this as the center, the sun, and then on a circle, on the points of the circle on the points of a circumference of a circle. Let me go back to the next slide. These are just analogous. One example in the real universe we live in could be our solar system. And anything, any points, any energy, any interactions, okay, all phenomena is a function of energy and vibration. So if, let's say, there is at the 0 degrees, which I'm going to designate arbitrarily as due east, if we're thinking of this circle as the compass, the face of a compass, or alternatively, if I think of it as the face of a clock, 3 o'clock position. If there were some entity sitting there, it could be you, it could be me, it could be, like they say in a textbook, a little homonucleus. They call that in engineering textbooks, a homonucleus. I always wondered what that was, but it is something to be positioned at that point on the circumference. Let's say, curious, we could utilize the circle as a mental construct for our solar system. Let's just say the sun being at the center. That's what we refer to as heliocentric celestial cycle analysis. There's geocentric, that for those of you who know what I'm talking about, great, but for those who are uninitiated into this, it's new, so that's why I'm taking the time to cut a little description here. But in any case, let's just say there's one planet in, we've got the planets revolving around in their orbits around the center of our solar system, which is the sun, our star. Okay, let's say there's one sitting here at the due east position, and there's one here at due north. That would be a relationship we call a square. They're 90 degrees of separation. They're perpendicular. And there could be, given the interaction, there's a gravitational interaction. It may not be electrical, but there's a similar phenomenon. Again, I'm oversimplifying a little bit, but for the purpose of clarity, not obscuring any of the reality of the effects and the phenomena that are really occurring in the real world. All right, so that's the point. I'm just using the circle and as a starting point to model, and recognizing and having identified it in our real world, our solar system, in a sense, exemplifies this mental construct of a circle. And it turns out that there are what we call fast planets, meaning that they move in their orbits at a higher velocity, and some more slowly. And by just as a little more detail there, the planets that are closer, they're not as far out or not as removed from the center of the circle, i.e. the sun. They move more swiftly in their orbits. They don't have, it's kind of like if you've ever seen a race, the people who have the inside lanes in any type of race, a race car, a horse race, a dog race, a runners in a track race, the ones who have the inside lane, they have less distance to travel. And so essentially they're able to get from point A to B quicker. The ones that are further removed from the center have a greater distance. They end up moving slower. That's what I mean by fast planets versus slow planets. Okay, so we've, over the last 50 or so, well, actually it's been over the 100 years or so, Gann had more, people like Gann, and even before Gann, but it turns out that what we widely recognize as the fast planets, the Moon, the Mercury, Venus, Mars, Sun, I use these for position trading. If you're a day trader, there are other things. I use what's called the ascendant, I use the midheaven, I use the Moon's nodes, etc. If you're day traders, suffice it to say, similar concept. I'm just kind of generalizing here. Okay. What do you do procedurally if I want to project and know with confidence when a market's going to turn out in the future? Well, I go in the history of the market, locate a high or a low day. I see what the celestial or planetary configuration was on that day of a point of significance, okay? And specifically, when the fast planets recreate aspects, or aspects is the word that's it's the professional term for the angular relationship. When any of those fast-moving entities are in an important harmonic or aspect or angular relationship, what are they? 0 degrees conjunction, 90 degrees, which is we call it a square, 180 degrees, which is an opposition, 120 degrees, which is a trine. Think of triangle, just dividing 3 into 360, you get 120. Simple arithmetic. No calculus, no advanced mathematics yet. Nothing you can't do with accepting addition, subtraction, multiplication, division, and a couple of percentages now and then. You can, and if for added measure, in case you want to get in anything complicated, we might have to move to a logarithmic scale. Sometimes we do that to normalize things on charts, but that's more price. Coming back in time, you really don't have to, although, yeah, for now, you can do addition, subtraction, multiplication, division, and a percentage. And even if you can't, the calculators in the world today can do it for you. That's all you got to have, and you can do anything we're talking about. When the fast planets recreate aspects with the slow, okay, that correlates with a cycle ending point. So if I have a means of knowing, if I find out where any one of these fast planets is relative to a slow planet. A slow planet would be, I haven't listed it here, those are the ones further removed from our sun, things like Uranus, Neptune, Saturn, Pluto. What did I miss? I think I mentioned them all. All right, those are the ones that are further away. The ones that are fast, closer, the Moon, Mercury, Venus, Mars, and the Sun. Okay, if there's any angular relationship between one of these fast-moving bodies and one of the slower, more distant moving bodies, that's important to take into note. Seeing that, now sometimes there will be, sometimes there won't, but assuming you can locate one or more of those, you then need to see when a similar angular relationship would be in place between one of these fast-moving bodies and one of the slower-moving bodies. When you get it, that tells you there is a greater than average probability for what happened on the day that, similar phenomena, a high or a low, a bottom or a top to form on that point in time. When a similar angular relationship sets up between any one of these fast-moving bodies and any one of the slower-moving bodies. Is that the only way I project when a market's going to reverse in the future? No, but it's a very helpful, and it is a generic approach. And there are countless variations on this theme, but just to keep life very basic for the moment. And this works very well. How well does it work? Well, this particular technique, I would say, I'm going to give it 67 to 70% reliable. I'll give it that. Again, keep in mind, putting this in context, folks, nothing based on price analysis, and clearly nothing based on market timing that I am aware of is perfect. There may be some things out there that I'm just not aware of. I even tell people to make a point. There could be, suffice it to say, let's say some alien technology that is perfect. I can tell you this, over more than 30 years of involvement and activity in trading my own accounts over the years, if there is that perfect idea, relationship, model, system, equation, set of equations, etc., whatever it is, I don't believe it's being it's pervasive or constantly being utilized, because if it were, by definition, you would see a disintegration of the systems we're trading in, because perfect information, objective, perfect information the market would get a hold of it. It would see it, it would discount it to the point where it ironically or paradoxically would be of no effect. I have not seen that over my time. I've been trading since I was about 24. I'm 61 right now. So I have not seen evidence of that degree of disintegration in any sector. And I have started my career trading equities, and then I went to options, and I went to derivatives. I got licensed on the derivatives side about a year into my career. Okay, and I haven't. And the last time I traded stocks was about 11, 12 years ago. But these are. It doesn't matter whatever the title is on a screen. If I'm thinking of them in an energetic standpoint, they are lines on a screen indicating a graphic of the energy behavior. And to that extent is how I typically start the process. So that's one technique. A completely but related different technique. It's different but related. I utilize something I call it the harmonics of 90. It's based on this. It comes from this, but a little more removed. And then I use a series of things. I use numerical, I use geometric, I use I use cyclical analysis. There's a lot of things, but we want to keep it simple to begin with. And then here's a greater concept also, folks. You should never, in my estimation, as best I know, you don't want to depend on any one singular technique, again, barring it being perfect, and you've proven it to be so, to make any decision or to derive any type of information, be it from the price piece of information, a price target, and or a time target. You could, but to the extent you rely more consistently on a multiple. It doesn't have to be an overwhelming lot of different indications or relationships, but if you've got 3 or 4 very different modalities, ideas, or ways by which you acquire and procure and derive the same type of information, it allows for convergences to set up, or if they're present, meaning what are the probabilities of any one thing being wrong? You have a Fibonacci study or a oscillator study that tells you the market's going to do such and such. Well, it works. If we back test this, we can find that this thing works 73% of the time, let's just say. You see? So that means 27% of the time it doesn't work. How do you know at any one outing this is going to be one of the 73% of the time it's effective and reliable, or is it going to be one of the times that it's not and you end up losing money? Thus the need for your capital money management rules and protocols and safety nets, etc. We don't know. But to the extent you have 3 very different ideas or relationships that all happen to be indicating the same output, it's less likely. The probability of 3 different things being wrong about the same market in the same way at the same time, although finite, is lower. And as such, it's more probable you're interpreting it correctly. So these are 3 different ways. I do this. I locate the high or low day. I see what the planetary profile is. Specifically, are there any fast bodies, planets, in an important angular relationship we call aspect with the slower bodies? If so, I then project out using what's called an ephemeris. If you're familiar with that, great. If not, don't worry about it. It's just a mechanism that indicates when different planets are in certain angular relationships, and it does it day by day. Years ago, you had to go to the library and get a book and then buy a book. Now it's all software. All right. So, and then along with that, I will apply harmonics of 90, which is a related technique, and then I do a time period analysis, which is there's all sorts of ways of doing that. One of the ways I use, as you'll see in a minute, is Fibonacci. A deep insight of people like Gann again and all the pioneers that did timing is not just to focus as time and give equal credence to time, but they are one and the same. And as such, whatever you do to time, you should do to price, or stated opposingly, conversely, whatever you do to price, you should do to time. So similar to algebra, if you have an equation, whatever you do to one side of the equation, you've got to do to the other, so as to create the equality, to persist or maintain the equality. All right. So here, I'm going to show you an example of how we can do this. This is the daily chart of the S&P, the stock market. So again, consistent with the previous slide, you pick an obvious top or a bottom. So November 9th, those, if you recall, 2016, if you see the pointer here, that was the election. Remember our presidential election in the United States. This is a daily S&P, front month, September. All right. So this, what do we do? If that's a point that sticks out, step one, you identify it. All right, next thing. This is a graphical program that I use to indicate, just imagine the circle. And it turns out that there was a fast planet. These are symbologies and glyphs, as they're called. They're just important relationships. This little blue thing here, if you see my pointer, represents the planet Uranus. It's a slow-moving planet. And this green symbol here, it's like a circle and a little cross underneath it. That's a fast-moving planet. That's Venus. And they happen to be at 120 degrees of separation. You can see the triangle here if you can. It's a little hard to see. There's a lot of busyness. Unfortunately, I should have highlighted that line yesterday when I was putting this together. I didn't have, had a problem, so I couldn't get the highlight. But suffice it to say, if you were to, the difference of separation on the circumference of the circle between this little circle with the little green cross hanging down, that represents a fast-moving body, is 120 degrees to this planet, a slow body. So we have a fast body connected to an important angular relationship. It's called 120 degrees. That was present, among other things, on a day. What day is this? November 9th. That's consistent with what happened. That was an important relationship cyclically, if we're studying this. Okay? Now, what an astro or a celestial cycle analyst would say is, we're going to progress this out into the future. When do you have that again occurring? And when you do, there's something, even if you guys are not, if there's some kind of connotation attached to the planets, forget that. Just think of numerical correlation. Something was happening on November 9th to create a cessation of the falling down and a reversal to the upside. By the way, guys, if you're a fundamentalist, there will always be some set of events. On last November, on the 9th, it was the presidential election. If it weren't that, it would have been something else. That singular thing or an accumulation of factors. There is always going to be, depending on, I'm not against fundamentals, I'm a technician, but but that doesn't mean I'm completely oblivious to fundamentals. I started my career, the very first book I ever read, Fundamental Analysis, Benjamin Graham. But Graham, God, Tittle, etc. But I am talking about convergence. Timing, I'm not saying we place a trade solely on the fact that we had actually I had projected November 4, the Friday before, but that's a separate thing, but to progress to show you as we move forward into the future. Okay, we had this date. It was, what do you do practically, procedurally? You identify a top or a bottom. That's just visual. You can see that. Here's a top. Here's tops. They're all over. And this was one that stuck out to me. So let's use it. It's a good example to illustrate a powerful tool. Okay. This is an important relationship. This blue thing here represents the planet Uranus. It's a slow-moving body. It's at where it is at its point in its orbit. This green symbol represents a fast-moving body. It happened to be 120 degrees. Aha! We have an important time-tested, back-tested relationship that we can look to. So how do we do it? We then, through software, years ago it used to be a book, doesn't matter. There are programs that I have or that you can get that will tell you when this or a similar relationship will be present again. When that is to occur, there's a better than average probability that you will have a turn. I'm simplifying a little bit, but not, again, for the purpose of clarity, not obstructing anything of critical importance here. It's that simple, if that is. Now, again, I'm not suggesting necessarily we place a trade. Okay, so the next time I have that relationship in effect, curious, July 30th. What's today, folks? July 11th. And so that's why I've penciled this in with a vertical line. The next time subsequent I have that same relationship that occurred back in November of 2016 is September 17. What does that do? I like to think of it as a temporal roadmap. It cues me. I'm not saying on de facto, by definition, I'm just going to go out and place a trade on July 30th and again on September 17th in the S&P or the stock market. You could. I'm not suggesting you do that. I am merely suggesting it is an additional piece of information, albeit from the time domain, that I can add to my whatever other factors that I feel are relevant to this system. By the way, this information, even if it turns out in retrospect, let's say we're in the middle of August at some point, and we look back and we see that the market turned exactly on July 30th. By the way, July 30th, guys, happens to be a Sunday. What happens if you project a time point, little detail here, that happens to come in on a day when the markets are not trading, let's say a weekend, holiday, etc.? Markets don't know anything about how we break up our calendar and the legislative rulings that we've decided markets are not going to be open on a weekend or a holiday. Markets don't care. Remember, markets are impervious to the universe around them. They just flow forward through time. We call them markets. They're entities, be it stocks or equities. It's a mechanism of financing the growth in our planet through equity. We have debt. It's a IOU. We have derivatives, which are a form of price insurance, etc. These are systems. I jokingly tell people in an economics class, the professor in the textbook will tell you these are modes of finance and ensuring the growth of a system, of a very complicated system, an economy, let's say, on any given level. At a very deep level, I think these are just systems for profit. As human beings, I always jokingly tell people we have ultimate job security as a trader, and it behooves you to hone your skills. Why? Because there's an aspect of human nature. We have, in the extreme, avarice, but our motivation for profit. Nothing wrong, I believe, intrinsically with that. We want to all gain. So it's energy is required. Money is just a form of energy. But I digress. Let me get back on point here. These are, if nothing else, these just tell me and give me an alert to expect there's a greater than average probability for a change. By the way, even if it turns out we're sitting here in the middle of August, this was perfect, a perfect forecast. At this time, having projected that prior to arriving to that future date, July 30, today's only the 11th, it does the analysis, the relationships themselves don't give me any insight as to whether it's going to manifest as a top or a bottom. Some techniques do. This particular technique doesn't. All it tells me is to expect that there is a market's going to change. And even it's not exactly telling me a top or a bottom. I might reasonably surmise it's going to be a top or a bottom. If the market's declining as we get to July 30th, my immediately response, I'm more likely to assume it's going to be a bottom. If we're rising, all this does is to expect a reversal to occur on or about July 30th, and similarly out here. I can project further out if I choose to. I just did it for purposes of presentation, the next two that are projected. So it's very straightforward, and that's one technique as to how to do it. Now, this was the profile November 9th. This is the planet here. It's a slow moving. This is a fast moving. They happen to be at an important angular relationship or aspect. When is the next time that will occur? Reflected in the July 30th. Which is a Sunday. By the way, when you have a time point coming in on a day when the market's not trading, you necessarily look to the next day. That's why on the chart I put what did I put, the 31st, I think. Or no, I put in the actual, but you would be able to exploit it on the day, either on a weekend, you look at the Friday before and the Monday after, clearly by practical. You look at the closest surrounding points. Okay. Next example, for those of you derivative traders. A soybean. This is a daily chart of soybeans. What do you do procedurally? You just visually inspect the chart. Locate an important, what you consider, I realize there's a modicum of potential subjectivity of interpretation and selection. But this is why, as a detail, we repeat this more than a single time. But there are going to be some things that stick out to you. Again, to the extent you have inappropriately selected the wrong starting point, you are hedging and dampening out any potential error because we're not depending on this solely. Okay. Here's an obvious bottom, June 23. Look at it. This is just a daily November expiry soybean future chart, daily chart. It's an obvious point. Clearly, look at what's happened since that bottom on June 23. Aha! I want to get some insight as to when the market's going to turn again in advance. What do? I look and see what, if anything, of interest was going on and in terms of the celestial profile on June 23. So let's do that. Here is the June 23 picture of the planetary relationships. What are we looking for? Fast connections or fast-moving planets connected in important angular relationships to the slow, the bodies that are further removed. They are more slow. For time, this is Mars, the little thing, the little red thing circle with the arrow pointing upward. This is Mercury, the little cross with the little things sticking up. This is the sun, and this is the moon. The glyphs or the symbols are pretty self-explanatory. If you're familiar with them, great. If not, don't worry. It's not important. Suffice it to say, you've got, these are all, Mars is a fast-moving, Mercury is a fast-moving, the sun and the moon are all considered the faster-moving bodies. And look at where they happen to be all clustered, very close one to each other. And it turns out that very important relationships here. We've got Mercury is let's see, what do we have? Where is this? Mercury is this Mercury is 180 degrees. This thing right here, it's like this brown symbol is Pluto. This is Saturn. Again, I don't expect, if you're not familiar, to memorize these. Suffice it to say, you've got a number, you've got at least 4 relationships all happening on this one day, June 23, 4 fast-moving planets connected to 4 slow-moving planets at important angular relationships. Thus, I am not surprised. In retrospect, I might have been clueless that if I hadn't checked this graphical picture of the relationships, the angular relationships around a circle. If you're put off by the word planet, just think of them as numerical angular relationships on a 360-degree circle. But look at the power and the acceleration of this move in bean prices. I don't know what's going on fundamentally in beans. I know we're in the summer. I know drought. I know supply-demand considerations. If you want to focus on that, and that's great. It will tell you and gives you commentary in real time. But I'm looking also, nothing wrong with that, but I want to embellish that with some knowledge up front that gives me edge. When is the next time I'm going to see, quite likely, a move similar to what we see, so I can get some advantage in trading to what we saw back on June 23. What do my procedures say to do? Check out the profile that was present at that point when you had an important, obvious pivot point from which we had great opportunity to make return. You see, right now, today, beans closed at $10.42 a bushel. Back here, we were at $9. Every penny is $50. Every dollar is 5,000 per position, just to make it real. Okay, so this is a very important profile. I'm not surprised. You have a plethora. You've got 4 fast-moving bodies: Mars, Mercury, Sun, Moon, combined or attached in important angular relationships. Opposition Pluto to Mercury. Mars is square, this little square here, to this. That's Jupiter. This little gray symbol here, that's the sun. It looks like a 4 with a modified number 4. That's Jupiter. This thing is Neptune. That's Mercury. That's a trine. That's a very important relationships. So it's no wonder we saw all of that energy came in, and the system had to destruct. That current trend coming down, it destructed because too much energy came in because of these angular relationships around the circle, and it created a destruction, meaning the ending of one regime and allowing for the onset of a completely different regime, i.e., as a technician, we call it a trend reversal, or as a market observer trader, we call it a reversal. From an energetic standpoint, the confluence of the particular angular relationships allowed for so much energy to come in, it overwhelmed the system, creating a ending of one type of behavior and the onset of a different. That's all that was occurring. The next time this happens, you have you have Mercury. This is something else. It's a node of the moon. This is the moon, Mars, the sun. And you have similar, this is Saturn here. These are the fast moving bodies trying to a slow, this is a semi-square to a slow. You have a, here you have a square from Mars to a fast, a similar, July 23. That's an indication to me. Aha, you have a similar configuration to what you had back a month ago, June 23. When is the next time that or a similar set of relationships will occur? Well, it happens to be on July 23. And thus, that's why I put that. I now have, here's why the vertical line. July 23, I think, is a weekend, so I put it on the 24th. So all this is serving as a graphical reminder to me as to when to expect. I can expect a type of change similar to what we saw in the past. You know, past tends to repeat. That's one of the premises of technical analysis. The fundamental premises of all technical analysis is that all phenomena, all information that is known, as well as all information that is not known, is implicitly contained or discounted, as we say, in the price. That's the primary central thesis of technical platform and theory. This, a close correlated premise of theory of technical approach is history tends to repeat. If not exactly, there's a recapitulation of phenomena that have occurred. And thus the notion of cyclical behavior and phenomena creating or serving as a catalyst for all price action. Okay, that's just a way to do it. All right. Here's a different but related way. I call this harmonics of 90. It turns out, and this is it's a consequence of certain planetary harmonics, but 90 as a unit of elapsed time. 90 what? Seconds, any amount of elapsed time. For whatever reason, without going into the theory of it, 90, when systems and an object, the right angle is an angle of change. Engineers don't build bridges anymore. The portions of the bridge that have to support forces and weight at angles of 90 degrees because it's too much of a change, and so you'll see on the structural parts certain other types of angles like 30 degrees, and because it more evenly spreads it out, whereas a 90-degree angle changes it and it's not spreading out the weight. And so years ago in the 1800s, the bridges were collapsing because we didn't know that. But in any case, systems like financial markets tend to change after 90 periods of a certain type of behavior or harmonics of that. The ones that are fractional parts or multiples, 45, which is 1/2 of 90, the harmonic or fundamental amount of time itself, 2 times 90, 3 times 90, 4 times 90. Those are some of the important harmonics of 90. And this is a very simple concept. When you run out, when markets have been running up or down, let's say, those are the two major types of price action. We know there's a third. A market can go sideways. But suffice it to say, the major opportunities for profit, net translation along the vertical axis up or down, by any one of these amounts of time, they are more susceptible to change. Well, if that's the case, which it is theoretically, we're able to then exploit that for profit in a very easy way. So let's show how that happens. Again, this is a daily S&P chart. So I have indicated here start dates, 11/9, March 1st, March 27, June 19. And these are time targets. As I've indicated, 45 periods of time elapse, 90 periods of time elapse, 180 periods of time elapse, 270 periods of time elapse, 360. So, to illustrate, November 9th, this is the daily S&P chart. Starting from that, if you run out by 45 days, it brings you to December 24. Run out by 90 days, February 7. Run out by 180 days from 11/9. Just use a calendar. Whenever you're applying time projection analysis, the question will come up, are we counting off the time in absolute time, calendar time, including holidays, weekends, etc., or just market time? That's a separate issue. It depends on the model and the technique you're applying. For what I've done here, I'm applying calendar counts. By the way, one of the reasons so few traders engage in market projection and timing is a little inconvenient. You've got to do a count. Whereas if we're talking solely about price dynamics, often most of the data is front and center on your screen. Here, by definition, it requires a count. Years ago, it would require a literal calendar, physical. I still use that. In the world today, we have software that will apply this and generate and derive the dates automatically with a few mouse clicks. Suffice it to say, that's what you do. So, for example, here's one. November 9, run out by 180 degrees, brings us to May 8th. Well, we've passed, so we can test it. It is this top right here. That was a perfect projection. I'm not suggesting that would have guaranteed a trader could have made money, but notice what happened. It was a top. So as such, it was a perfectly reliable projection. Give you another one. March 1st. It's the top. Oh, by the way, procedurally, similar to the first idea, you just select a starting point. How do you do that? Well, this is a simplification, but you're probably not going to be too far off in locating or by starting with tops and bottoms that stick out to you. And so I started with March 1st. Here's your start date. Notice 45 days away ends up at April 15. Let's look at the chart and see what, if anything, of interest was occurring on April 15. April 15, it turns out, was a perfect hit, even though it was the weekend. So what do you do when you derive or end up or project a time point that happens to fall on a date when the market's not trading? You necessarily look at the surrounding date. So in that case, that probably would have been somewhat materially helpful in trading, in making your decision. Again, I'm not suggesting we're placing a trade solely on this, but to the extent you had that information, again, any time after or as of March 1st, you had, and this was, 3-4 weeks in advance, or actually that was like 6 or 7 weeks in advance of that. So you had plenty of time. Way in advance you have had that opportunity. May 30th. Let's see what was going on May 30th. That was a bottom right here. This is to the day. Based on this, from the March 1st starting point that I selected, you run out 90 days, it brought you to May 30th, you see, etc. So that's another correlated or ancillary technique. Now, going to the future, this is just the S&P. What have I projected? July 30, September 17. This is a different technique than the looking for the fast planets matching up to the slow planets. When you've got 2 or 3 different methods, any one of which works X% of the time, doesn't work X% of the time, when 2 or 3 different models happen in spite of their differences to give you the same or nearly the same answer, you can attach a greater degree of importance or credence to it, is the idea. Very simple concept procedurally. Simple to do, a little labor intensive, but with the software of the world today, makes it almost as easy as it is simplistic to understand. A similar idea, but a variation. This is where I'm going to use time periods, not a time, well, it's using some Fibonacci ratios. Again, in accordance with the greater concept of whatever we do to price, we should be doing to time. If I'm interested in projecting a level of support or resistance, i.e. a price point where a market's likely to turn, I should similarly project, and I do so using a Fibonacci ratio, let's say. Why not utilize a Fibonacci ratio to project when in time a market's going to change its course? There are many variations on this. Here's a very simple idea. This is Tesla, a daily chart of Tesla. What do? I locate a time period. What I did is I took a bottom on February 27, and from that point in time, February 27, to another important ending point, a bottom on May 4th. That's the period that I looked at, from February 27 through May 4th. How long is that? What's its duration? 66 days. One of the techniques I will apply is to take that amount of runtime, 66 days, and obtain harmonics of it. One of the ways I do it is by multiplying that period, 66 days, by 4 of the important Fibonacci ratios. 0.618, 0.786, which is rounded to 0.79, 1.27, and 1.618. If you're all familiar with that, great. If you aren't, that's a separate form of analysis. It's the mathematical foundation of Elliott, but that's a separate discussion. Suffice it to say These numbers here are important. They are called Fibonacci ratios. One of the ways that can be used to enable me to project a time point out in the future is by multiplying them by important periods of time that I've located off of a chart. You can get, it's not no obscure data. I've just located it what I consider to be an important period. That begs a question, how does one know what's an important period? You don't. So this is why I'm not saying this is absolute, but there are ways to dampen the risk that can arise or creep in if you have inadvertently selected the less than perfect time period. But in this case, let's see what happened. And I have cues on how, when I teach people, I give them some guidelines by which they can more effectively, more judiciously, in a relevant manner, know in advance by looking at any chart, any market, any time, how to select the best time periods. Okay, so I picked this one, a period of time bracketed by this bottom that came in on 2/27, February 27th, through the higher bottom, May 4th. What do? You figure out its duration, 66 days. What do you do then? You multiply it by those 4 levels. You get 4 answers. I simply run out by those 4 amounts of time elapsed from the end of the time period. The end of those respective projections then generate, in this case, 4 specific, highly reliable time points. Well, let's see. Some of them have come, some of them have already passed. Let's see what happens. The first one came in at June 14th. And that was, I purposely put in this graphical vertical line 1 day offset. So you can see it was a perfect top here. That was June 14th. This is the 13th, but I wanted you to see that it was a perfect top. The second one was June 25th, also a perfect top, offset 1 day to the left to the previous day. And then the future, July 27, this is the next one that I projected using this one time period, and then subsequent to that, August 19. So we've got 2 dates out of the 4 that I've projected that have come and gone, 2 remaining for to the future for Tesla, using the very simple Fibonacci time period technique. All right, so as an example, if nothing else, again, none of these techniques align you with a top or a bottom. They simply indicate a change. If you look at the trajectory of the trend at the time the market reaches one of these levels, you're in a better position to make an assumption based on other factors. But all this does is arm you with temporal information to indicate a greater than average probability for a change in trend, or an aspect or an attribute of the market componentry to adjust. That's all. Any questions, folks? That's just, let's see, I see here, let's see. Okay, Brad, you're asking the other lighter lines, so probably grid lines. Let me double back and see. I'm not sure. The dotted lines are just the grid lines of my platform. This was a Metastock platform. This line these are just lines from the past that they've come and gone. Once you've passed a time point, it's of no practical value to you at any juncture. But if you're referring to these lines, those are just the grid lines of my platform. They're irrelevant to the analysis. All right. How do I determine a start point? Hold on, folks. I've got my gardener outside, so I've got to close the window here. All right. If you can hear the background noise. All right. How do I determine, that was someone's asking, how do I determine a start point for my count? Depending on, good question, Brad. That is the million-dollar question. Depending on the particular technique, if it's the time period analysis, for example, I may use bottom to bottom, top to top, bottom to top, top to bottom. Those are 4 types of time periods that one might locate or think about when you look at a graphic price chart if you're doing this type of Fibonacci time period projection. If you're doing the harmonic of 90, which was the previous technique, where I just started with a given date, say whatever, and you run out by the respective 45, 90, 180, 270, 360. There are other important amounts of time elapsed, but those are important. That's a little more tricky. Suffice it to say, you probably, not always, won't do too far off the mark if you select an obvious top or bottom that sticks out to you, but that's where error can creep in, because what's obvious to one observer may not be. There's the potential for subjective interpretation to come in, and this is why you have to buffer this with other ideas to that extent where you're trying to locate. A mere repetition of the process goes a long way often to dampen any error of the possibility of incorrectly selecting a starting point. Okay. What is my definition? Someone's asking, what's the definition of the energy that I say causes a change from a peak to a bearish direction? Let me make sure I understand. What is my definition of the energy that I say causes a change from a peak to a bearish direction? Good question. I'm not sure. I want to make sure I'm not sure I'm going to answer it because I don't quite get it, but I want to make sure. Here's the model is that information in our world we call events, fundamentals. And by the way, it could be economic data, a jobs report, a consumer confidence report, the unemployment numbers, a statement by the Federal Reserve if it's a financial market. It could be an earnings report if you're an equities trader. If you're an agricultural commodities trader, you're trading corn and wheat and soybeans, it would be the crop report. It could be a weather report because of soil moisture content considerations and how the supply. It could be Department of Agricultural levels, or it could be that the USDA is in talks with, on a grain shipment to China. It could be any number of things, but basically information, if it's of the right type relative to a given market instrument, let's say, and if it's of the right severity, then it has the potential, and only then, to impact a market and break it away from its current regime. I jokingly refer to as information as little containers of energy. If the information, by virtue of its type, if whatever has happened, an event has transpired in the universe, in the world, and it's and if it's of the right magnitude, meaning it's the right intensity pertaining to a specific market, then it has the potential to, again, fill up that system. Remember what we said at the outset of the slideshow to create that theoretical foundation. Markets are just an object. All objects, by definition, have their constituent componentry. There's a structure. And based on that, the shape and the structure, its internal architecture, it will be more susceptible and likely to accept certain wavelengths or frequencies of energy. Alternate forms or amount of frequencies will be reflected. Some energy is absorbed, some energy is reflected. That which is reflected, external to that thing, that's how we identify it, because that's what impacts our retina or our sensory realm, our sensory apparatus. If I see the apple, again, by using that as a basic example, and it appears to be what I define, I use the word in the English language, red. Red simply means it's a portion, it's a certain frequency of vibration, and I call it, on the electromagnetic spectrum, the color red. A different frequency I might call a color blue or green or yellow, whatever, or brown, whatever the case might be. That which I see is that which has not been absorbed by that thing. Everything I don't see has been absorbed. That's why I don't see it. It's going inward. It's going in the opposite direction of my sensory apparatus. Whatever I perceive and observe, let's say visually, and I define it to be a certain vibratory rate that I call red, is how I understand. I've learned about a property of that object. Similarly, when I apply a set of timing relationships, or it's easier to think of price. Let's say you put an oscillator on a chart or a moving average overlay. It's based on the formula and the interaction. When you throw something up against the object of your inquiry or your interest, based on that, some of that energy that is absorbed by the object of the target. Some of it is reflected back. It is the reflection of the energy of whatever wavelength it is that is how we learn something about that system. So more directly to your question, whoever asked, when enough energy comes into the system, let's say a financial market, so much so based on certain amounts of time passing that correlate with the allowing, let's say there was the entry, the opening of that container becomes wider, allowing more energy to come in. At some point when that system fills up with so much energy, it can no longer be contained because it's obscuring the net content of and volume of that container. It's got to go somewhere. If you keep forcing energy into it in the manner analogous to the opera singer continuing to vibrate at a high frequency, it's got to go somewhere. In the same way that the positive charges, if there's no space, where does it go? There's only one. When you've considered the possible and you don't come up with an answer, consider the impossible. It's got to go somewhere. It will break through it will force its way in the battle or tug of war of energies. It will break the container that contains it. And that's what creates the ending of a trend. And it allows for, on a continuum of probabilities, a new trend to begin. That's the theoretical basis by which a market forms a top or a market forms a bottom. So hopefully, hopefully that gave you a theoretical breakdown as to how a market changes its trend. Change from peak to bearish. Okay, let's see here. What is my definition of the, how do I determine a starting point for my count? Okay, the way you're, I think Brad is asking me, how do I determine a starting point for the count? If I weren't thinking in my head of what I know, I would, that terminology is usually referred to like an Elliott count, but then since I'm doing a program on market timing, I'm thinking maybe you're using the word count in a broad sense, meaning how do you know where to start to generate your count? I don't. That's what I was saying a minute ago. That's a trickier question. That is the $30 million question. And as such, there is some uncertainty there. This is why, to mollify and mitigate and dampen out the uncertainty that's often attached with the selection of the starting point, let me put it this way. What I do know is this. The reliability of your projection that you've started from a particular point in time is only as good as the veracity, as the legitimacy, as the appropriateness of that starting date. I do know that. So the reliability of your forecast is a direct function of the correctness of your starting point. So it's important to try and get that right. That's a goal we objectively strive for. How to do so, especially when, if you think about it from a timing perspective, there's no way you can test for the potential veracity, and you won't know for absolute certain until it's too late, by definition. This is why, in principle, I'm not suggesting we make our trading decisions solely on time. I tend to, but that's a more detailed thing. But in principle, to the extent you can have all different types of information, price and time, colluding, coming into alignment, creating a convergence, whatever you want to call it, a cluster, is the extent to which you can trust more implicitly in the collectively agreed upon output, you see. So, but that said, the quick answer is very often you probably won't go too far off astray in the application procedurally of this type of idea in selecting a top or a bottom that sticks out to you. That's not saying, I'm not saying that tops and bottoms that stick out to you are the only starting points that are appropriate, but probably it's not at all that bad a beginning place to think about how to do that procedurally. Okay. What is my definition of the energy that I say causes? Oh, I think I answered that. Okay. Those planetary examples that I'm looking at, how do I know which instrument to apply them to? Good question. Well, that's a separate, that would be, I mean, the way to reformulate that question so as to make it general, that's a function of filtering and how you as an individual market participant, you the observer, the trader, the investor, etc., how you come to select the particular universe of stocks, bonds, commodities, precious metals, forex pairs, whatever instruments you're trading. That would be how, that's the answer to your question. It's a function of what you like to trade, however you came to discover your universe. Usually that's a separate subject for a separate webinar, but in principle. So it's not like I'm arbitrarily, just randomly ad hoc selecting markets. I trade pretty much a relatively small, manageable set of markets. But in general, everything I've presented today is universal application, be it stocks, bonds, commodities, etc. Hopefully that, Brad, I didn't mean to give short shrift to your answer. It's just that there's infinite, I mean, there are 10,000 US stocks here. I mean, there are ADRs, there's anything, but that would be a fun, whatever instruments you trade for whatever reasons, these techniques, these ideas are applicable, I guess would be a better indirect way. I don't mean to sidestep your question. It's just, that's a separate, it's beyond the scope of today's presentation, but it's a good point. Would I apply? Yes, I could have equally applied. I do look at gold and silver. I trade silver extensively, so in markets related to that. So yes, anything. I just, for time and space, didn't have an application to gold. But yes, I would apply these ideas and similar ideas as well as others related to gold. Yes, and oil. Yes. Can I apply this to Forex? I certainly do. I do all sorts of things. They're myriad. What I didn't get into, again, for a time, there's some geometric techniques that I utilize, especially. I earn most of my money, 80% of my personal income from Forex, so long-term and short-term, and I do a lot of intraday in the S&P E-mini, but again, they have universal application. Sharon is asking that, can I apply this to Forex? Yes, I do most of my personal activity in Forex in the last 3 years in particular. Great. Do I trade the Forex? And I am? Yes. Yes, I am. Sharon, I guess. Yeah, as I just indicated. Well, great, guys. I think we're out of time. I think I've gone over. I did not mean to, but hopefully you've gotten something out of this. And if you have further questions, here's the contact information, 800-339-8588. Once again, I'd like to thank Adrian and the folks over at Trading on Target. This is the first time I've had the pleasure of doing a presentation at the invitation of Adrian and her group. She has great stuff, and I know her focus is on the psychological components and aspects of investing and trading. And to me, in a broader sense, that's the most important thing of all. Today's topic was on something very specific, a technical analysis part of the process of being successful in investing and speculation. But overriding that, I tell people there are 3 major spokes of what it takes to be successful investing. Number 1, the analysis in your models, and we talked about a very specific component of that today, market timing. It's my area of research. Number 2, money management. That's how you work your resources. Once the analysis is designated and designed to lead you to good opportunities. How you efficiently use your financial resources is under the auspices or umbrella, I think, of money management. Thirdly, but by no means the least important, to me it's of greatest importance, are the internal, how your internal state is, and that's what we put under typically trading psychology, the emotional aspects, and I know that's what Adrian focuses on and has for many years, and I've been fortunate to be privy to her material and learned a lot over the years. So all 3 of these things, in my estimation, must come together to optimize your chances for success. So again, Adrian, thank you, and hopefully for the audience there, you've gotten something out of this. And till next time, folks, I wish you a great day and profitable trading in the days and weeks and months and years to come. Until next time.